Hey guys, Rick and Michael here. We are in our new office. If you haven't come to see us yet, come hang out. Today we are talking about a topic that one of our clients emailed us about. So we always love that. You have a topic that you want us to cover, let me know or let us know. This is specifically around an article in the Wall Street Journal from about 2 weeks ago, titled "A Time-Honored Strategy Puts Your Retirement at Risk." And so, Michael, what they were talking about in that obviously was the rule of thumb 4% rule, where you only take 4% of your portfolio out, your portfolio value out per year, and you'll be fine. Adjusted for inflation, you'll never run out of money. Vanguard kind of sunk its teeth into this because it worked really well with its 60/40 portfolios. Um, and the gist of it is that might not work as well as people are anticipating. So we're going to address, what's in the article today and kind of how we get around the 4%, in our case, 5% rule, and what that means. So, um, I guess Michael, just walk us through why a 60/40 portfolio, and if you're taking out 4 or 5%, might not be the best way to think about the next 10, 20 years of withdrawals.
Yeah, the thinking around putting your money in a 60/40 portfolio, 60% stocks, 40% bonds, is that the good and bad times for those asset categories will come at different times, providing diversification benefits. 2022 really highlighted the fact that they can both go down at the same time. It was the worst year on record for bonds. They were down 13%. Stocks like the S&P 500 or global stocks were down anywhere between 18 to 25%.
Yeah,
So
there's nowhere to hide in 22.
there was no mix of stocks and bonds that you could have that would not lead to substantial losses for the year. And so, for us, and this has been something we've done over the long term. This is not a result of what happened in 2022, and we've got to reduce that risk moving forward. This has been part of our process since we began. And it's expanded diversification. So we incorporate asset categories and strategies that are not part of traditional stocks and bonds, that the good and bad times are going to come at different times. So the important thing is they've got good long-term return potential, but different sources of risk. So for example, in 2022, what we would term our alternative investment category was actually up 13%. And so for our clients, somebody that was invested in our most aggressive strategy would have been down a little less than 100% bonds, which is kind of crazy to think about. But it's really due to that alternative category being positive. So it's
benchmark to benchmark, they were down like 16. We would have been down like 8.5 or something like that.
Yeah. So for our balance strategy, which is kind of what you would talk about for a 60/40, we were down almost about half what the 60/40 portfolio is. And there's two things to really think about that are important when it comes to drawdowns in your portfolio. One, in retirement, we talked about this briefly, but sequence of return risk. It's the risk that early on in retirement, as you're taking withdrawals, you might, over the course of your retirement, average 7%. But if the first couple of years are bad years, your portfolio won't recover because you're drawing assets. It's dollar cost.
We'll throw a chart up here. We cover. If you've ever been to one of our classes, you've probably seen this chart, but we'll throw a chart up magically here. What it says is that if you have $1 million and you need $50,000 a year, adjusted for inflation, 3% more every year, okay? If the first 3 years are -10, -5, and 0, that's not even a terrible 3-year stretch, honestly. And then the next 27 years, you make 7.5%. But you started with that $50,000 need there up front. You crash and burn in year 22. Like, you're out of money. You flip that and you make 7.5% for the first 27 years, and then you go 0, 5, -10, you're fine. So it's really about not necessarily the 4 or 5% rule. It's more about matching your withdrawals to your time horizon, making sure you don't have things that are subject to those downturns, and really kind of what, if you're a client of ours, you've heard us talk quite a bit about, is the income that's being thrown off from those portfolios. In, for instance, the balanced portfolio. Some people, if they're below a 5% withdrawal rate, almost doesn't matter what the market's doing that year, because they're getting that amount of income from that portfolio.
Yeah, that's a good point, Rick. Income can be very stable and even rising as security prices decline. And so the more that you're able to source your withdrawals from income rather than capital appreciation, you'll have lower variability in that from year to year, which is important. The second point to highlight that I don't want to understate is that When you're going through those downturns, particularly in retirement, that is difficult to stomach. It is, you might have the financial capacity to deal with it, meaning you've got enough assets to weather it if you stick with the program. But when your portfolio is down 20%, and you're pulling out 4%, right? The 4% rule, the 25% reduction in your assets, that's tough. It's tough for anyone to stick through. I don't care how long you've been investing, particularly during the accumulation phase. It's just different when you're taking money out of your portfolio. Psychologically, that can be a huge barrier to someone's success at that point. And so for those reasons, we've created these strategies that we believe are better diversified. And the interesting thing is we're almost at 9 years for these strategies of audited performance. We've had, when you look at the upside for the market, what percentage are we capturing of that upside return, right? It's 100 to 120%, really, depending on the strategy that you're looking at. But our downside is, meaning if the markets or the blended benchmark is down, what percentage of that downside are our clients experiencing? So and it's significantly less. Yeah. So for our balanced strategy, it's right about 70% of the downside, 100% of the upside. So I always like to say, I don't know if you remember the old Miller Lite commercials, great taste, less filling, but it's kind of
how many cliches can we throw out right now?
I don't know.
Keep in the fairway, hit singles and doubles.
Don't swing for the fences. Yeah.
Better batting average.
It's fun to laugh about, but this is very serious. We're talking about people's success in retirement. The last thing that I wanted to point out is that many of the solutions that people are using out there, 60/40 is a variation of it, but target date funds, balance funds. Hey, I'm going to put all my money in a target date fund, target date now. If you looked at the target date now, I'm retiring now, in 2022, many of them were down more than 20%. So, I don't necessarily think that those are the best solutions for people at retirement, particularly if the withdrawal rate's a little higher.
You can't pick what you're selling either if you want to take a withdrawal. We talk about this in class.
Right.
Like you can't pick and choose. Like
Can't say,
she's like, oh, this is up,
great
this
point.
is up, rebalance. That doesn't really exist in a target date fund when you're trying to decumulate out of there. So it's not a great for that. But.
And the final thing that I would say is that, we put an extra layer of protection in place for our clients in retirement, where if they're at an elevated withdrawal rate for a period of time, sometimes we'll see this happen. You're going to retire at 62, defer Social Security to age 70. Maybe your withdrawal rate is 6, 7, 8% until you get to age 70. Then it drops down to 2 or 3%. Well, there's that gap that you need to plan for. And we use what we call a safe account. So this is a way for us to segment assets that are invested very conservatively so that we're not taking the market risks that you'd be exposed to in a 60/40 portfolio, which does two things. One, it keeps our longer term assets intact. We don't have to worry about it. And two, for a client visually, when you see, hey, this is a whole separate account. The stock market's down.
I'm good.
20%, but my safe account is steady. That's where I'm sourcing my withdrawals for the next few years. Yeah. Psychologically, that can help lead to a more successful outcome.
Yeah, a lot of times we have like 1 through 5. If you've heard us talk 1 through 5, that's just our lingo between us for 1 being pretty conservative, 5 being the most aggressive. Mike's like someone might be a 3, middle of the road, but then they get to that situation Mike was just talking about. We put a little bit of money in a 2 safe account, and maybe the rest of it's in a 4. Right? You're blended at a 3 basically, but you're psychologically okay because you've got the 2 there, the safer stuff.
The lower the number, the more conservative. The
we're trying to keep up with
growth oriented.
The growth in the 4. So, if you're a client, you've probably heard us all those things before, but that's why the 4% rule is not necessarily as straightforward as I think it came out in like the 80s, didn't it? Like the 4%.
That's what the article said. I'm not familiar with the original white paper or research that came out around that, but that
it was an advisor, just an advisor just like us. It was like, hey, 4% sounds good. That seems to work. So.
My entire time in the industry, that's been something that has kind of been a heuristic or rule of thumb that 4% is a safe amount to withdraw.
You start throwing in like the bucket strategy and hey, I need a car this year or pay for a wedding this year. Like if you throw 4% out the window, like it gets choppy if you start looking at outflows. And
it's critically important to match your cash flows and your investments so that your time horizons are aligned. If you don't, it works for you as you're saving the ups and downs of the market. You know, you put a fixed dollar amount of every paycheck into your investments. As the markets go down, you're buying more of those investments. As they go up, you're buying less. So you're, putting yourself in a position to dollar cost average into a lower cost, right? The opposite is true when you're withdrawing. I've heard it described as dollar cost ravaging for that reason.
I think you made that up, didn't you?
I didn't. I don't know who to credit for that. I love our industry. There's all kinds of jargon and lingo, but anyways, yeah, those are the reasons why it's important. That's how we try to position our clients to be successful in managing that, both in trying to reduce the risk of a large drawdown for purposes of, eliminating or, diminishing the sequence of return risk, and also keeping clients invested.
Stay diversified, know your time horizon, know your cash flows. You'll be good. Thanks for hanging out. We'll talk to you soon.